Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 228 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you into our world from the past week in the world of financial markets and financial planning. So this week, Nick Whitaker, our Director of Research and Trading, is back filling in for Matt. So thanks again for coming back on the show, Nick.
Yeah, of course. Always good to be here.
As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on November 29th. S&P 500 index up 8.5% for the month and up 18.5% for the year. The Dow Jones Industrial Average up 7.2% for the month and up 6.9% for the year. The NASDAQ Composite Index up 11% for the month and up 36.2% for the year. The Russell 2000 Small Cap Index up 8.8% for the month and up 2.6% for the year. And the Vanguard All World ex United States ETF up 8.1% for the month of November and up 8.3% for the year. 3-month Treasury rate sitting at 5.45%, the 2-year Treasury rate at 4.64%, and the 10-year Treasury rate at 4.27%. So moving on to big headlines and current events from this past week. I think the biggest thing, Nick, was that sadly Charlie Munger, who was Warren Buffett's right-hand man, passed away earlier this week, and he was 99, but he helped Warren run Berkshire Hathaway, obviously, had a tremendous impact in the investing industry, is viewed as one of the legends, really, when it comes to investing. So, our industry, I'm sure, is saddened by that news, but, he did a lot of good things for the finance industry, I think.
Yeah, he did. He's I think one of the reasons you see so much news coverage on it is a lot of times some of the moguls and some of the big names on Wall Street and finance, they might not be the most likable or have a bit of an ego to them, like some of the big hedge funders and whatnot, and Charlie Munger and obviously Warren Buffett, they don't really have that same kind of aura about them. They seem pretty down to earth, but also just incredibly successful. And so yeah, there's been a lot of good research, and I've read a bunch of great quotes this week from Charlie.
Yeah.
So
yeah, there's no shortage of great quotes from Charlie. So if you want to go ahead and take a look at those, just throw it into Twitter or Google or whatever, and you'll be able to find a bunch of them. So some of them are pretty comical too.
Yeah. He definitely he had some sass to him at times.
Yeah, he had a sense of humor to him.
Yeah.
So, last but not least, the U.S. dollar fell to a 3-month low on Tuesday this week, which was further fueling stock gains that we've seen. And, Nick, we've kind of been pounding this table really all year that in order for stocks to continue higher, we needed a weak dollar, because there has been a pretty strong inverse correlation between the U.S. dollar and stocks. So the dollar continues to weaken and stocks continue to march higher. Moving on to tweets, articles, and research from this week. First thing I had, Nick, something that we've mentioned a couple times this year. This was a tweet from, the Nancy Pelosi stock tracker on Twitter. And this was from November 16th. And they said, alarming news, Senator Tommy Tuberville, whose net worth is approximately $16 million, is betting against Tesla. Tuberville recently invested $50,000 in Tesla $190 puts expiring on December 15th. And again, just to kind of pause there for listeners, Nick, when we're talking about someone buying options and buying puts specifically, if you buy, let's say, as Tommy did, a put option on Tesla at $190 per share, that gives Tommy the right to sell Tesla to somebody else at $190 per share prior to December 15th. So essentially, it's making a bet that Tesla's share price is going to fall between now and December 15th. Because let's say Tesla, falls to $150 per share by December 10th. Tommy can then send or sell Tesla shares to somebody else at $190 a share and buy Tesla back at $150 per share, and he just made that $40 per share profit, right?
Yeah.
So it's a bet that Tesla is not going to perform well, over the next month or so. They continue to say that the unsettling practice of politicians leveraging positions over companies they legislate promotes a critical discussion on the ethical implications of whether such speculation actions should be permissible in public office. And I'm still kind of amazed that we're still having this conversation, Nick. I mean,
It's
I
it's
am
not
and I'm
it's
not.
a bit it's a bit ludicrous that the
It is,
conversation's still going
and
on.
there's been
Yeah.
several examples this year
Yeah.
of members of Congress trading options and buying and selling stock on companies that they regulate, like that they
Yeah.
directly have oversight over.
Yeah.
And in
Prior to
my
major news being released too.
right, and in my opinion, that's a huge problem. So I'm still kind of shocked we're still having this discussion, but at the same time, I'm not, because
Yeah.
we're talking about the people that vote on laws in
Yeah.
this country.
Yeah.
Maybe we shouldn't be so surprised. But I mean, and it's not. This isn't a Democrat thing. This isn't a Republican thing.
Yeah.
It's
It's a
a
both.
political
It's
problem,
both. Yeah.
right?
They're both incentivized to not pass legislation that allows them to bet on stocks that they have inside information
Oh
on,
yeah,
right? They
I
both
mean,
parties do.
if people want some entertainment this weekend, take some time and Google, the net worth of these politicians prior to them going into office and then after
Yeah.
office. So
Yeah.
it's
Or
pretty
yeah,
wild.
or Google how much money they make on certain trades or I mean there's
Yeah,
all
there's
kinds.
a bunch of websites out there that that post all of these
Yeah.
trades by Congress, and there's even an app now, Nick, that you can like open up this app, and it's a trading app, and you can literally trade the same way these politicians trade. And obviously it's going to be delayed because,
Yeah.
that time
Yeah.
until they're mandated to file those trades is a little
And that
lagged, but you can
yeah.
literally, buy and sell the same things that these politicians are buying
Yeah.
and selling. So, um, yeah,
Yes.
I just thought it was interesting.
So for people who are curious, the politicians, they do have to report, or they're supposed to report when they I think it's 30-day lag. I could be wrong on that.
Yeah, I'll
But
look
they,
it up
but
while you're talking about it.
but they do have to report on the names that they invest in. But there's been some speculation that there are a decent percentage of politicians that they just don't report it. They just
Within
just refuse.
45
Yeah, they just
days of the
45 days.
trade.
Okay.
Yeah.
Yeah, they just don't report it. So it's interesting to see like some of the ones that do report or like this researcher is obviously called the Nancy Pelosi stock tracker. Nancy Pelosi is one of the ones that is just brazen with it.
Right. Not even
um,
trying to hide it.
she's not even trying to hide it, right? But um, she reports it. But there are other members of both parties that you look at their net worth and you're like, we know they're invested in the stock market, but yet you look at the history of their transactions and there are none. It's like, wow,
And
okay.
some of them, I think, like Pelosi in particular, you look at her
Or
performance over the past, two
yeah,
decades has been better than like 95% of the
yeah,
smartest investment managers in the world, right?
yeah. Oh yeah, yeah. It
So,
helps when you know it's gonna happen.
yeah. Yeah,
She
it does.
literally
It sure does.
at times has the crystal ball, and people,
Yeah, it's funny you
uh,
said that. I was just gonna say that. We always talk about having that crystal ball.
yeah,
You
yeah,
know.
that's it. And people, and another thing listeners might be thinking about is, oh, okay, well, why don't people just follow what they do? You can, but most of the time, by the time you get that 45 days of information, the gains have already hit
It's
the
already
stock.
happened.
So you
Yeah.
can buy, but you'll probably end up underperforming using that strategy,
Right,
unfortunately.
exactly. And the same thing on the sell side when, these politicians sell, or close out these positions.
Yeah.
Again, it's a 45-day lag. So, a lot can happen within 45 days as we've seen,
Yeah.
Nick.
I mean, think about 45 days ago, what people were talking about in the market and how, stressed certain segments of the media were about, where the performance was. So a lot changes in a month and
Yeah.
change. So
Yeah. Moving on, next thing I had, Nick, was a tweet from Brad Freeman on November 21st, and this was about NVIDIA's earnings report. So NVIDIA, largest semiconductor, in the publicly traded markets, absolutely had a amazing earnings report, right? Um, just a couple numbers for you here, Nick. They beat revenue estimates. They beat earnings before interest and taxes estimates. Um, you know, and these were all double digit beats. They beat revenue estimates by 12.5%. They beat earnings before interest estimates by almost 19%. They beat GAAP earnings by 22%. Um, they beat earnings per share estimates by 61%, and they guided for the next quarter and the next couple of months higher than expectations, right?
yeah,
Um,
that's the big one too. That's the
yeah,
big one.
and this next chart, Nick, is wild to me. I'll have Jenna throw this up on the show notes and the YouTube page, but it shows NVIDIA's Q3 revenue every year since going public, and they just reported, obviously, a week or a week and a half ago, Nick, and year over year, their Q3 revenue is up 206% year over year. And this chart is just like kind of wild. It's like,
Yeah,
this bar is almost going off the page here.
yeah,
And why do I bring this up? This is, to me, a perfect example of a stock pricing in positive developments in the future. So from January 1st of this year, Nick, through November 20th, which was the day before Q3 earnings were reported for NVIDIA, the stock was up 245% year to date. Okay.
that's pretty
And
good.
after this amazing earnings report, I don't know how you could get much better. The stock was down almost 1% the day after the earnings report. So this is a really good example of, us as investors need to remember that stock prices are a representation of what happens in the future. Not about what's going on right now, not about the earnings report that just happened, not about things that have happened in the past, but it's all about the future. And again, this is just my personal opinion. The triple digit gains that we've seen in companies like Nvidia this year, it's because people are forecasting these types of earnings reports going forward. So I don't think any of us should be surprised by the strength of Nvidia at this point in time.
Yeah, no, not at all. The street was almost expecting them to come out and beat across the board. I think if they didn't beat as substantially as they did, I think the stock would have been down and even a little bit stronger.
Right.
Two quick points. One, just to let listeners and viewers know that when we're talking about these past two names, Tesla and NVIDIA, it's not a recommendation for or against these names. We're just bringing up examples to talk about bigger picture stuff. And the second piece is uh, this second chart you put up here, where it shows the Q3 revenue since going public. I've talked to people in the past, and they've asked a good question about what's the point of going public and why, and This is a good chart to illustrate that, and it's access to the capital markets that allows you to build and grow your business and scale your business at a more substantial rate. Um, Without access to the public markets, there's no way you see this kind of revenue growth for really. I shouldn't say this type of revenue growth, but this type of revenue growth, including the fact that we're talking about $18 billion, the
Hmm.
substantial actual quantity, um, allows you to scale, allows you to take on debt. So it's a good kind of chart to illustrate that point. Um,
Yeah, thanks for
so
bringing that up. It's just the
yeah,
pool of money grows
yeah,
substantially when,
yeah,
anyone, virtually anybody can invest
yeah,
in a company's stock and, provide capital than
yeah.
just,
And yeah, you
private
think about like
markets.
an Amazon, for example, you can start once you have access to the debt markets, now you can and the capital markets and you're public, you can start buying up little small companies as tack on acquisitions to really build out. And then all of a sudden you're adding their revenue to your profile. And those types of transactions are a lot easier whenever you're public.
Hmm. Yeah, great point. Last thing I had, Nick, was a kind of just a brief summary of a talk given by Morgan Housel on November 2nd in Detroit to the CFA Society. And this summary was written up by Peter Lazaroff, who has been a guest on the podcast before. And Morgan was speaking about why people like predictions and misunderstand risk. So this was right in my wheelhouse because I am a strong advocate against market predictions, and this really hit home with me here with what Morgan had to say. So he starts off by saying, Morgan shares two reasons why predictions will never go away despite the horrible track record in the financial industry. First, it's exciting to predict change. It can be extremely lucrative if you're correct. So we're always going to be drawn to predictions. And we saw this, in the great financial crisis. People were predicting the 50% market correction. And those people who predicted that and got it right are still reaping the rewards from that, right? They're still getting media time. They have a lot of followers out there on social media. So they got the audience, they captured that audience.
Movie rights.
Movie rights, right? Second, there's a lot of discomfort in the uncertainty that humans feel from the idea that the future is inherently unknowable. And predictions, even if incorrect, reduce that discomfort. One really important point that Morgan makes is that the financial industry, as well as many other fields like politics, medicine, etc., are reasonably good at predicting some parts of the future, but they are terrible at forecasting the surprises, which tends to be all that matter. Events from the past 25 years that truly moved the needle in the economy and changed the world were surprises like 9/11, the Lehman Brothers collapse, and COVID. The common denominator of all three of these is that nobody saw them coming. These once in a decade events are always going to be impossible to predict. Risk is what's left when you think you've thought of everything. It's great to analyze all of the risks in front of you and come up with a probabilistic analysis of how they're going to impact you, particularly at the individual level as you think about the risks to the personal finances. But then you have to accept that the biggest risk is what's not on that paper, and it's always been like that. You can state with certainty that the biggest economic event over the next 12 months, 5 years, or 10 years is something that nobody in the world is thinking about. And with all these examples of risks that nobody predicted, they seem obvious with the benefit of hindsight.
Mm,
Um, so I have nothing else to add there, Nick. I thought it was really succinct summary by Peter of, kind of what me, you, Matt, others in our
yeah.
industry think about this. We like to uh, have predictions pretty much in everything in life, right? Because we don't like uncertainty. For example, like going into a golf tournament, I have a golf partner that he comes and plays at my member guest. I play at his member guest. His name's Chad. weeks leading up to it, we're like, hey, how are you playing? How are you playing? How do you think we're gonna play? And it's like all of that, none of that matters. It's just
Yeah.
it helps with discomfort. And that's why, I was able to sympathize with this article so much is because I realize it in my day-to-day life, and it's no different for the markets.
Yeah, 100%. And I think there are so many examples of this. If you look at most major market corrections and major market corrections and recessions, most of the time they're triggered by events that there's no way you could figure it out.
Right.
So I encourage
Right.
listeners to Google it and read about it, read about recessions, and I mean you can go all the way back to like the 1600s of economic drastic economic changes just kind of happening where it's like there's no way you can predict that kind of stuff like COVID.
Right.
So
Right. Yeah, and actually it would be an interesting exercise if we go back, Nick, and before all of these major shocks to the system, if to see what the consensus politician trade was, to see if they were in
mm,
groups liquidating before these events, because that would be pretty interesting. So maybe we'll run through that exercise here over the next couple of weeks.
oh yeah.
I'll turn it over to you.
The first I have a couple quick pieces for us today. The first one's on energy demand and capital discipline. It's a tweet from Markets and Mayhem on 11/27, stating the following: Emerging markets oil demand is rising as U.S. producers remain capital disciplined. 2024 may bring firmer demand and ever tight supply. Will we see triple digit oil again? Um, Again, predictions. Who knows? I really just wanted to bring this up just to remind listeners as to what's going on with the U.S. energy markets and specifically U.S. energy producers remaining capital discipline. That's the part that really sticks out to me because it's so important for these companies that they remain capital disciplined because that's what shareholders and Wall Street wants. They don't want these U.S. producers to pump too much oil out of the ground. They don't want the U.S. producers to use more debt and erode their balance sheets and erode their cash and their cash discipline. So they don't want to see their free cash flow going down. And that is one way that you can bring the oil price down is of course by increasing the supply. But to increase the supply, you have to increase the amount that you're pulling out of the ground. You have to put some more money into it. You have to go and get out in the fields, build more rigs, et cetera, et cetera. So there is that kind of balance for U.S. producers that they have to walk that tightrope, so to speak, of remaining capital discipline, keeping shareholders happy, um, pulling enough out of the ground to realize the profits, try to keep the oil price somewhat where it's reasonable. Obviously, OPEC is going to impact that more than U.S. producers, but this certainly goes into that. So I just wanted to
Yeah,
kind of
and
bring that up.
at
Well, we have
least
a
in
chart here that we can throw up for you guys as well.
And at least in Dayton, prices are sub $3 right now.
Mm,
I
yeah.
think I saw like $2.90 the other day, so not too bad as of right now. But like you said, it's anyone's best guess as to
Yeah.
where energy prices are going to go and what that impact is going to be on prices at the pump.
Yeah. I think for the producer or for the individual, that's obviously tough. For U.S. producers, I from an investment perspective, from a shareholder perspective, I think this is a good thing from from an investment perspective in U.S. energy stocks, right? You want to see them remaining capital discipline, um, I think, and
Hmm.
I think that's the consensus on the street as well. So we'll see what happens. The next piece I have is a historical chart on Fed tightening, and this is research from Urian Timmer. He's head of macro strategy at Fidelity, and he says, I love Urian's charts. They're really cool. He kind of has his own way of building these charts, and I've used a lot of them in the past. So we'll throw this up for you, and then I'm going to read what he wrote here. If the Fed has reached the end of its tightening cycle, as is widely believed, what is next? As this chart illustrates, history offers a vast range of potential answers, from aggressive dovishness after the 1989 peak to the back for more hawkish path following the 1959 peak. Typically, an easing cycle starts relatively soon, although the Fed has from time to time stayed sideways for a while. I'm going to pause there because that's where the market, that's what the Fed is discussing, and that's, I think, where the market is still trying to figure out is what is that sideways? How long? What does longer for long? Um, what does it
Higher
mean
for
to?
longer.
Yeah, thank you. Higher
Yeah.
for longer.
Yeah.
What does that actually look like? That's where the market is really trying to figure that out. Where is that on the chart, right? Um, uh, Continuing back to what Urian said, we'll see how it goes this time. But interestingly and heartening, but interestingly to see how diminished the market's expectations have become over the prospect of a large pivot. The market is now expecting the Fed to give back around 150 bips of its rate hikes over the course of the next few years, which seems reasonable. And we'll throw this chart up for you, and it shows the bright blue line there is the average. So you can kind of see that once you reach the peak, most of the time it's pretty quick back down. Most of the time. Now the
In
Fed is
terms of
obviously
interest rates, yeah.
in terms of interest rates. Yeah, yeah, we're not talking
Hmm.
about the stock market here. We're talking about yeah, the interest rates. And I think this is a contributing factor why the market is obviously so hyper focused on what does higher for longer mean. Is it going
Hmm.
to be 6 months? Is it going to be a year? It's going to be 3 months.
Right,
So
because that has a broader effect on the economy and the availability to take out money out for loans. It has an effect on housing prices. It has an effect on mortgage rates. It has an effect on what you're getting paid to hold cash in your bank account or a money market account or a certificate of deposit. So it really does have an effect on a lot of areas of people's lives. And usually when we have a easier monetary policy, meaning lower interest rates, it incentivizes people to borrow money and spend money and have that circulate throughout the economy, which is a good thing. Again, anyone's prediction as to what exactly happens with interest rates. I don't even think the Fed knows what's going to happen, with interest rates or what
yeah,
their decision is going to be in a couple of months. It is a really good piece, and Urian does provide great content. So
yeah, pretty cool charts. So thank you, Urian. The last piece I have is from our friend Charlie Bilello on U.S. housing affordability. He says the following: U.S. housing affordability is worse today than the peak of the last housing bubble. The median American household would need to spend 44.7% of their income to afford the median priced home, which is a record high. And there's a chart that we'll throw up on the screen for you guys. This kind of falls right in line with the Fed rate hikes. And why has the Fed hiked rates as much as they have? It's to combat inflation. Um, and obviously, uh, that's had an adverse reaction or an adverse effect, I should say, to individuals' bottom line, so to speak. And that's you're really starting to see that in the housing market, because the housing market as much has not had that fall off that some people were predicting. It's stayed relatively strong. So you add that with higher interest rates and higher inflation, price of groceries going up. Um, it, this chart is pretty representative of what's going on. So even regardless of what we've seen and what the Fed was studying with the employment situation, which is still relatively strong, um, there's the consumers still have been hit to some degree.
yeah, I mean, just when I first read this, I mean, I was kind of like, wow, that's a lot, right? The
Yeah.
median
Yeah,
American
yeah, it's a
household would
lot.
need to spend, almost 45% of their income to afford the median priced home. So,
Yep.
the middle
Mhm.
of that.
Yep.
But it's interesting, Nick, because if you go look at this chart, prior to the great financial crisis, we were right around 42%. So not that far off from where we are now.
Yeah.
And, I think housing is an interesting topic because I think there's a ton of recency bias. Like, if we
Oh,
just
yeah.
take the GFC out for a second, where would we be in the housing and real estate market if the GFC never happened, right?
Yeah, absolutely.
Um, and it's because there was just this one massive event that happened that influenced that industry and that market for over a decade. And I wonder, I'd actually be interested to see this chart go back to like the
Yeah,
1970s to
yeah,
see,
I wanna see it back further as well. That's
because I think
almost
a
every
lot
time
of
I see a chart.
yeah, a lot of the housing conversations and
Yeah,
prices, like a lot of it, I think it's recency bias because we had this big event that forced prices down and interest rates down super low, right? And that has almost become the new normal. So when people see stuff like this, they're like, "Oh my God, this has never happened before. This is crazy." And
yeah.
it's like, well, actually, prior to 07, 08, it probably wasn't abnormal to have, data like this.
Yeah, I think it's definitely on the high side, but, yeah, obviously the great financial crisis really reset the housing market down, and particularly, as you're looking here and thinking about just kind of like household budgeting and whatnot, you're thinking about that 30% range. I also think it depends on the market you're in, and regionally. I mean, you're probably not going to be on that 30% if you're in some of the major cities, Chicago, New York, San Fran
Right.
for sure,
Yeah.
right?
Oh gosh.
So
Yeah.
it depends. This data is always interesting. It's a nice it's nice data to see to try to suss out the big picture, but that's another thing with housing and inflation. It can get very regional, and impact different regions pretty drastically.
Yeah.
So
Yeah,
we,
for
we
sure.
we try in the industry our best to understand, the median and the means and that side of things. But when it gets down to, all the way down to the individual, that's where, um, it just depends on the individual situation, right?
Yeah. And that's kind of a good lead in into our financial planning topic of the week, Nick, which was a tweet from Ben Carlson on November 17th. Jenna will put this up for our YouTube viewers and our podcast listeners in our show notes. He says, "Why there won't be a housing market crash in one headline." And he shares a picture from Business Week, and the title of the article is "The Share of Americans Who Are Mortgage Free is at an All-Time High. Almost 40% of US homeowners own their homes outright as of 2022, many of them baby boomers who refinanced when rates were low." And I thought this was really interesting, Nick, because, for the past however many years, couple of years, everyone and their mother is predicting a housing market crash because of how
Mm,
quickly home prices have skyrocketed after COVID, right?
mhm.
Um, and I can tell you from talking to a lot of baby boomers about this specific subject, a lot of them aren't rushing to sell their homes that are paid for, right? So if you're
Yeah,
waiting for housing prices to collapse, you might be waiting a long time. And again, I think a lot of this has to do with recency bias, that the last housing market recession, was the great financial crisis. And not all housing slowdowns are going to look like that. Prices aren't always going to fall by 40 to
yeah,
50% or even more. I mean,
yeah,
just think about it. Why would the majority of Americans sell their current home that's paid off to buy number one, a more expensive home, and number two, have a more expensive mortgage rate or a mortgage rate at all.
Yeah.
I just don't see that happening unless there's another catastrophic, you know, economic event that would
Yeah.
force people to tap into the equity of their home, and that's really getting down the rabbit hole. But
Yeah.
it wouldn't surprise me if these housing prices, to use something that you said earlier, stay higher for longer.
hmm Another scenario to play out for listeners regarding the baby boomers is, okay, you have a house that's paid off. Why, if you want to downsize, because that's typically what you would see is, maybe someone wants to downsize or they want to move to more of a retirement location. What what's the downside of just holding on to it for a few more years until rates come down?
Right.
Right? Why wouldn't you do that? And then at that point, okay, you still might be paying a higher price for the home, but at that point you can finance it much cheaper. Um, why wouldn't you just kind of wait if you can? Probably should.
Right.
So
Right.
yeah, I agree with the article. I don't expect the housing market to fall off a cliff. And we've been talking about this for years at this point with people asking us questions about, what's up with the housing market and is it going to fall off? And I think we talked about, expecting to see a little bit of a pullback, which we did for a while. Not drastic, but a little bit, and it's kind of gone back up a tick. But I think a lot of it, like you mentioned, gets down to demographics and COVID kind of accelerating some of the younger generations push into home ownership. Yeah, that pushed kind of jumped the housing prices. What feels like kind of astronomically, but if you smooth that out over a curve, it's, I suppose, reasonable. While it's frustrating for most of us out there, that's the reality of economics, unfortunately.
Mm-hmm. Mm-hmm.
Yeah.
And I'm trying to pull up some data on Y charts, Nick. Maybe we can discuss this maybe next week or sometime later this year. But just to look at the relationship between mortgage rates and the average price of a home, right? Um,
Mhm.
because that, in my
I
opinion, would
we we've definitely seen research on that, but I don't have anything at the top of my head um, built for that.
maybe
But we we've
this could
seen
be a
charts, yeah,
separate podcast topic. But yeah, I
seen
mean,
charts in the past about that.
because if rates go back to zero, I think you're going to have a spree of a buying activity, because there's
Yeah,
there's been a lot of people that are waiting for things to get a little cheaper before
yeah.
buying a house. So
It makes a massive difference, and that's what it gets down to on the individual side of things is when you're buying a house at 5, 6, 7% versus 3, 4%. It's drastic. Your mortgage payment is drastically different.
hmm
So yeah, I get it. It's tough. It's tough, but
yeah, I
yeah,
got I got a lot of friends that
stay.
are
Yeah,
looking around and that are
yeah,
renting right now and want to buy a house or buy a piece of property to start building that equity.
yeah.
But they're just like, I just every house I look at, it's like there's no way I'm paying that for
For what it
for that.
is, yeah.
Yeah, exactly.
Yeah, I dealt with that in the Charlotte market back in this a few years ago, 2019. I felt like that, where I'm looking at these homes and like, wow, this is crazy. And it's really funny because those same homes that I was looking at are 100% more expensive now. Maybe
Right.
not 100%, but drastically more expensive. And I'm just still scratching my head. So I was thinking there's no way it'll keep going, but it did.
Yeah.
And that gets back to that comment I made about the median household and all of that. Regionally, it does have an impact where it affects every region, yes, but the degree to which it affects a region can be somewhat drastic. If you're
Right.
looking in somewhere in the Midwest, outside of a major city relative to, like I mentioned, Charlotte or Chicago or those major cities, it's going to feel much, much more drastic because it probably is.
Yeah, for sure.
Yeah.
For sure. Um, Really quick, just wanted to throw a quick note in there for listeners. If anyone is interested in creating your own podcast, please use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. And again, you can receive your first month free with promo code Jessup Wealth, all lowercase with no spaces. Anything else we want to mention before we sign off for the week, Nick?
No, I don't think so. Hope everyone had a happy Thanksgiving and enjoys the holiday season coming out.
Yeah, definitely. Crazy to think that we are going to be entering the last month of the year here tomorrow. So
Yeah.
happy December to everybody, and we will be back with you on the next episode of the Independent Advisors podcast next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.